On January 3rd, 2026, at 2:01 in the morning, American helicopters touched down in Caracas. 30 minutes later, Nicolas Maduro is in U.S. custody. In one night, Washington has effective control over the largest proven oil reserves on Earth. That single night did more than topple a government. It helped set off the largest wealth transfer in modern history. On television, it looks like justice for a broken regime. In financial terms, it is something else. A move to pull roughly $10 trillion worth of oil into the reach of a government that is running out of clean ways to fund itself. At the same time, back in Washington, federal debt is already above $38 trillion, and interest is racing toward $1 trillion a year. Prices have climbed faster than wages, so people see bigger balances in their accounts and still feel poorer at the checkout. Put that together, and the Venezuela raid stops being a local headline. It is exactly the kind of operation. You see, when an empire has promised more than its real economy can comfortably deliver, its currency has already been weakened, and it still has the power to reach for hard assets rather than admit that the numbers no longer add up. If you zoom out over the last 2,000 years, you see the same rhythm again and again. Rome, the Dutch Republic, the British Empire, different flags, the same sequence. It starts with sound money and real growth, then comes expansion and generous promises, then rising debts, weaker money, and resource grabs abroad, ending in some mix of inflation, default, and a reset of the system. Ordinary savers lost purchasing power. Governments and well-connected insiders came out owning a larger share of the real assets that survived. You can break that rhythm into 7 stages. In that 7-stage cycle, the Venezuela raid is a classic stage 4 move, the point where a dominant power leans harder on oil and other hard assets to prop up a strained money system. In the next few minutes, we will break those 7 stages down, show exactly where the Venezuela raid sits in stage 4, and follow the money from Caracas all the way to your bank balance. So by the end, you know whether you are on the paying side or the collecting side of the biggest wealth transfer in modern history. If you remember only one idea from that framework, make it this. Big trading empires tend to run through the same 7 economic stages and end up in the same kind of trouble, even if the dates and slogans change. Stage 1 is sound money and real productivity. Stage 2 is expansion and generous promises. Stage 3 is military overreach and a weakening currency. Stage 4 is the grab for hard assets. Stage 5 is confidence in the currency starting to slip. Stage 6 is debt so large that it begins to steer policy. Stage 7 is the reset, through inflation, default, or some mix of both. Keep that simple ladder in your head as we go because it lets you line Rome, the Dutch Republic, the British Empire, and the United States up on the same track. Take stage 1. Early Rome struck silver coins that actually contained silver. The Dutch guilder rested on credibility and tight public finances. For centuries, the British pound was tied to gold and backed by a navy that made trade safe and profitable. After the Second World War, the dollar took that role. At Bretton Woods in 1944, it was fixed to gold at $35 an ounce, and other major currencies were pegged to it while America held most of the world's official gold. If you held dollars in that era, you effectively held a claim on something real. Government did not need financial tricks. Trade, technology, and industry did most of the work. Real businesses thrived more than financial schemes. Savers were rewarded, and a broad middle class could grow on the back of productive work. That is what stage 1 looks like when it is working. Once an empire is rich and feels secure, politics shifts from how do we survive to how do we share the winnings and keep everyone calm at home. In Rome, that meant free grain, public entertainments, and big building projects. In Britain, it meant railways, imperial administration, and social reforms, paid for by income from a global empire. In the United States, the post-war boom funded Social Security, Medicare, and Medicaid, the interstate highway system, mass education, research spending, and the space race. For a while, real economic strength carried the bill, factories were busy, exports were strong, tax revenues kept up, and debt stayed manageable. Then, quietly, the line is crossed. The state starts spending more to keep citizens and allies comfortable than the real economy can sustainably produce. There is no alarm when that happens. You do not get a push alert on your phone. It shows up slowly in budgets and bond auctions, in the way the promises grow a little faster each year than the underlying income. That is how stage 2, expansion and generous promises, rolls into stage 3. Great powers do not just fund pensions and highways, they also fund militaries, protect trade routes, maintain distant bases, and fight wars that are meant to be short and decisive, but rarely are. Rome paid to guard frontiers. From Britain to Mesopotamia, the Dutch financed fleets and colonial garrisons. Britain ran an empire on which the sun never set. The United States took on its own global load, from Cold War containment through Korea and Vietnam to a permanent network of bases, and later the war on terror in Iraq and Afghanistan. The arithmetic is simple. The the bills rise faster than tax revenue. In theory, there are three honest ways out: cut spending, raise taxes, or admit you cannot pay everyone back in default. In practice, empires almost always reach for a fourth option. They weaken the currency. Rome literally shaved silver off its coins and mixed in base metals. Over 2 centuries, the denarius went from almost pure silver to almost none, and prices in parts of the empire rose many times over. In the modern era, the mechanics look different, but the effect is similar. In 1971, the United States closed the gold window and ended the dollar's formal link to gold. From then on, the currency was backed by confidence and by the state's promise to tax and borrow in the future. Later, repeated rounds of quantitative easing saw central banks create new money to buy government debt and other assets. On paper, this makes debt easier to carry and smooths over crises. Underneath, the logic is blunt. More units of money are chasing roughly the same amount of real goods and services. Over time, that gap shows up as inflation and as a slow, grinding erosion of what savings can actually buy. That is stage 3, currency debasement tied to military and fiscal overstretch. And by this point, Rome, the Dutch, Britain, and the United States have all been there. Once a currency starts to look shaky, people who understand the system quietly shift their focus to things they can touch: oil, gas, copper, ports, pipelines, farmland, strategic companies. This is the point where empires lean hard into acquiring real resources, sometimes through markets, sometimes through diplomacy, and sometimes, when those routes fail, through force. They do not say, "We are doing this because our debt is too big and our money is being hollowed out." They talk about security, terrorism, narco-trafficking, human rights, restoring democracy. The motives are mixed, but the economic pattern is clear. A heavily indebted power whose currency anchors the world system keeps finding itself in crises in regions rich in strategic resources. Now bring Venezuela into view. For years, it has been a textbook case of resource dependence gone wrong, an economy tied almost entirely to oil exports, run by a regime that used petrodollars to fund subsidies and patronage. When oil prices fell and mismanagement, corruption, and sanctions piled up, the productive base collapsed, infrastructure decayed, hyperinflation wiped out savings, and millions of people left. Underneath that social and economic wreckage, the geology did not change. Venezuela still sits on the largest proven oil reserves on the planet, hundreds of billions of barrels under a mismanaged and sanctioned economy. On paper, at moderate oil prices, that represents well over $10 trillion of potential revenue over time. Now, drop our near-future raid into that picture. Operation Absolute Resolve, the January 3rd mission that sends U.S. forces into Caracas to capture Maduro and fly him to New York, is sold as a law enforcement move against an indicted narco-terrorist. What follows is talk of American companies going in, billions of dollars in promised investment, and long-term contracts over Venezuelan production. On paper, a huge block of underground wealth has been pulled into a new sphere of control. In practice, the main winners sit in distant boardrooms and, on the other side of the ledger, in a treasury that has bought itself a little more breathing room. That is stage 4, a stretched empire using its military and financial weight to lock down hard assets that can help support a highly leveraged system. The catch is that stage 4 almost never solves the core problem. It buys time, it may add some revenue and produce a short-term boost, but it does not change the basic gap between what the state has promised and what its real economy can deliver. While attention is fixed on raids, resource deals, and foreign politics, internal strains keep building. Stage 5 is when ordinary people start to feel that something is wrong, even if they cannot put it into charts. Inflation stops being a number on a policy report and shows up in the weekly shop. The rent bill, the insurance renewal, interest on savings is stuck at 3 or 4%, while the cost of living jumps closer to 8 or 10. The account balance rises on screen while its real buying power shrinks. Those with access to hard assets, prime property, solid businesses, commodities, tend to keep ahead of price rises. Those holding cash or fixed income slip behind, and the middle class feels squeezed. The same pattern appears between countries. Central banks do not hold press conferences announcing they are losing faith in the dollar. They simply diversify a little more each year. Over the last quarter century, the dollar's share of global foreign exchange reserves has drifted from above 70% into the low 60s, even though the system still leans heavily on it. At the same time, global millionaire migration has surged, with well over 100,000 high net worths. Individuals expected to move across borders in 2025, and even more projected in 2026, the largest voluntary movement of private wealth on record. They are leaving high-tax, politically strained, or fiscally stretched states and heading for places that offer lower taxes, stronger property rights, and more stability. You do not have to admire those choices, but you should notice what they signal. People with options are quietly positioning for a more fragile monetary order. That is stage 5, not collapse, not yet, but a visible crack in confidence in the existing currency and the system built on top of it. Before we move fully into stage 6, it is worth spelling out how the wealth transfer actually works in practice. Start with financial repression. Imagine inflation running at about 6% a year while your savings account pays 2%. On paper, your money is still there. In reality, you're losing roughly 4% of your purchasing power every year. Scaled up across tens of trillions of dollars in savings and bonds, that gap quietly shifts a huge amount of wealth, from savers to whoever issues the currency and owes the debt. Now add what economists call the Cantillon effect. When new money is created through government borrowing, central bank actions, or credit growth, it does not hit everyone at once. Now, those closest to the tap, governments, large financial institutions, big asset owners, get to spend that new money before prices have fully adjusted. By the time it reaches wages and small savers, the prices of assets and essentials have already moved. Put those two mechanisms together and you get the core logic of the modern wealth transfer. The system does not need a loud default. It can shift purchasing power quietly, year after year, through slightly negative real interest rates, steady inflation, and new money flowing through the top of the system first. Stage 6 is where this meets a new constraint. The debt has become so large that it effectively pushes the central bank around. For decades, the official story was that independent central banks set rates to keep inflation low and stable while governments borrowed as needed. That story only holds while the debt is small enough that higher interest rates do not blow up the budget. With U.S. federal debt now in the high 30 trillions and interest costs no longer a rounding error but on track to rival major spending programs, that limit is being tested. The more rates rise, the more tax revenue is eaten by interest on existing debt. Former Fed Chair Janet Yellen, citing Congressional Budget Office projections, has warned that debt is on course toward roughly 150% of GDP over the coming decades, and that the preconditions for fiscal dominance are strengthening. Fiscal dominance simply means the debt burden is now so heavy that it effectively dictates what monetary policy can and cannot do. Raise rates high enough, for long enough, to crush inflation, and the interest bill on the stock of debt explodes. Keep rates too low for too long to keep the debt affordable, and inflation, or the constant risk of it, becomes a way of life. Either way, the central bank is no longer steering freely. It is reacting to a fiscal machine that is already in motion. At this point, governments lean harder on quieter tools, holding interest rates below inflation, so the real value of their debt erodes over time, nudging pensions, banks, and insurers through regulation and incentives into holding more government bonds than they otherwise would and making small, technical changes in how inflation is measured and reported. Critics argue that, taken together, this acts like a slow, hidden tax on savers, a soft default that shifts wealth from holders of money and bonds toward the state and toward those closest to new money creation. That is the heart of the wealth transfer argument at this stage. Not a single dramatic day when all debts are wiped out, but a long period in which purchasing power is quietly moved away from ordinary savers and toward the center of the financial system. If you listen to official speeches, the story sounds reassuring. Debt is manageable as long as the economy grows. Reserve currency status makes us different. New technologies will boost productivity and outgrow the problem. There is some truth in that. Growth does help. Reserve status does buy time, and innovation can raise living standards. The problem is that in late empires, debt has usually grown faster than the real economy. Earlier reserve currencies like the pound, the guilder, and silver standards all believed they were different, and none escaped the arithmetic. And technology did not save Rome from overreach, or stop Britain losing the pound's dominance after 2 world wars and repeated devaluations. When you strip away flags and slogans, you see the same basic playbook: inflate debt away faster than most people notice, use rules to keep savings parked in government bonds, grab hard assets abroad to support a weakening currency, and tighten controls when too much money tries to leave. Once you recognize that pattern, the news stops looking random. Historically, after an empire has clearly entered fiscal dominance and confidence has started to drain away, the endings fall into a few broad types: a restructuring or default, where debts are written down or repaid in devalued terms, a period of high or runaway inflation that destroys the real value of the currency and clears the books in a chaotic way, or a long spell of financial repression and low growth that slowly rearranges who holds wealth and power. Rome cycled through inflation, heavy taxes, and shrinking trade. The Dutch lost financial leadership to London after war, and excess debt broke their system. The British pound, once the leading reserve currency, lost its anchor when Britain was forced off gold and was later displaced by the dollar. By the time you reach the equivalent of stage 7, the old setup is exhausted and a new one takes shape. In every case, people who held their wealth only in the old currency paid the highest price, while those who owned real assets like productive land, essential resources, and solid businesses, or who had diversified into the rising system, fared much better. The details change, the structure does not. So where does America sit in that 7-stage arc now? The sound money in early expansion era is behind it. Overstretch and debasement arrived with Vietnam, the closing of the gold window, and decades of cheap credit. Resource grabs and alliances tied to oil and strategic commodities have become a recurring feature of foreign policy. Loss of confidence is visible in the slow decline of the dollar's reserve share and in record flows of wealthy people and capital into perceived havens. Fiscal dominance has moved from academic worry to something former central bank heads warn about in public as debt and interest costs climb. No one can timestamp stage 7 in advance, but history suggests that once a system is clearly in fiscal dominance, and many people doubt the long-term value of the currency, the shift to a new monetary order tends to unfold over a decade or two, not overnight. That sounds long until you remember that is exactly the horizon for retirement savings, mortgages, and the financial prospects of a generation. Imagine 10 more years on this path. Your paycheck is bigger in dollars. Your bank balance is the highest it has ever been. Your rent has doubled. Insurance feels predatory. Your parents' pension buys half the groceries it used to. There is no announcement that the system has collapsed, just a steady feeling that you are running harder and not getting ahead. That is what late-stage monetary transitions usually feel like from the inside. Not movie-style catastrophe, but an invisible treadmill speeding up under your feet. This is not about panic. It is about having a clear frame. If you understand that we are in the late stages of a well-worn pattern, your choices about money, work, and risk will look very different from someone who assumes the current system will roll on unchanged. History does not hand you a trading plan, but it does offer a few reliable lessons. First, currency risk is real. Keeping most of your wealth in the money of a heavily indebted empire has rarely worked out well over 30 or 40 years. Second, real assets matter. Land, essential infrastructure, resilient businesses, and key resources have again and again held value better than paper promises when systems reset. Third, skills travel. In crisis after crisis, from repeated devaluations in places like Argentina to post-imperial Britain, people with valuable, portable skills found ways to adapt, earn, and sometimes thrive. Fourth, optionality is a form of insurance. Multiple income streams, diversified savings, and, where possible, access to more than one legal or financial jurisdiction all increase your ability to ride out volatility. None of this requires belief in doom. It simply asks you to accept that, over time, arithmetic and incentives win. When you hear officials talk about the national debt, it is usually framed as an abstract problem for future generations. In reality, the adjustment is already happening through your cost of living, your wages, your taxes, and the steady erosion of what your savings can buy. When inflation runs ahead of deposit rates, when new money is created to support government debt and markets, and when policy leans toward keeping the debt machine turning, the difference is made up with your purchasing power. That is what people mean by a great wealth transfer, driven not by a single law or secret plot, but by the way late-stage monetary systems work. Could it be different this time? Maybe productivity really does surge. Maybe leaders choose hard, disciplined reforms instead of easy money. Maybe the United States manages a controlled glide into something more sustainable. If that happens, in 20 years we will simply say we were overly cautious. But every empire that believed it was the exception eventually ran into the same arithmetic. Rome had concrete and aqueducts. Britain had the Industrial Revolution. Neither could keep spending far more than it took in without consequences. Faced with that record, I would rather prepare for the pattern than bet everything on a miracle.